Welcome to the briefing for Tuesday, the 18th of October. Just taking a quick look this morning. Obviously, there's a bit of risk on appetite in regards to a bit of a gap higher in the DAX future, and we've kind of continued that trend so far this morning. Consequently, this S&P future tracking that movement upside in the DAX. Obviously, we'll be looking at that high print that was seen really at the end of last week on Friday, that coming in at 10,610 level, which is just short of the R2 at 17. So a bit of upside, and really there's not a hell of a great deal to pin it on. We had a higher close on Wall Street. Some of the energy names seeing a bit of reprieve on the back of continued uptick seen in oil yesterday. We had that Genscape figure. I think it was a draw of over 2 million, which is one of the largest for that specific piece of data that I've seen in many months. And so we've kind of continued that trend overnight in Asia, reversing a lot of that downward move that was seen yesterday, if not the entire sell-off from yesterday, from that point of the afternoon when the US came in. So a decent kind of, from the $50 handle, which we briefly flirted with, we're now back up 20 cents shy of 51. So a positive close on Wall Street. Not too much movement overnight in Asia, but just leaking into sentiment, I guess, this morning and helping lift markets slightly from the off. Bunds pretty flat overall. You can see pretty quiet trade. Likewise with the US 10-year only down marginally. FX markets, the dollar touch softer, down around 0.1, but again fairly minimal movement comparative to recent weeks. But the pound continues to see some further gains. Cable already up this morning. We're going to talk about that a bit more detail about the UK markets in this briefing actually. But looking at the charts here, well, this was overnight actually. We had a pretty decent move overnight. No real new UK news flow, so to speak, but a lot of focus on UK yields, which have been rising, and that byproduct strengthening potentially a bit of the sterling currency on the back of expectation of higher inflation to come and tying the hands of the Bank of England to cut rates. So liquidity overnight, you know, you're aware of that now with that algo flash crash we had just a week ago. This just though the opposite direction of price movement, but you can see it's a pretty decent move overnight, and we've kind of held on to a bulk of that this morning. So things were very quiet yesterday overall as a session. It is a Jewish holiday yesterday and it continues today, so volume wise it could be similar. However, we do have some more interesting data than yesterday, as we have inflation readings both the UK and the US. A quick look as well, last night we had a couple of, on a micro level, some US earnings. Now Netflix, you know, peers talk to you about how to understand earnings season, and it's not always about large market cap stocks. Then yes, there is that direct correlation in terms of if it's weighted large enough, then obviously it will move the overall index itself. But sometimes sentiment stocks can be really key to an insight in towards consumer appetite and overall spending. And Netflix is seen as one of those kind of tech names which have been inflated around a year ago or so. They were seen as some of the key bellwethers to kind of judge that. And Netflix last night, they rose around 20% after market. So their shares shot higher after they passed forecasts for subscriber growth in the third quarter. And so continued exceptional demand for that service. However, on the flip side, IBM, which is a much larger company, they actually fell last night around 3% after market. Don't forget, the company came within a hair's breadth in the third quarter of ending a long series of quarterly revenue declines stretching back more than 3 years. That's a positive. They actually topped revenues and their earnings topped Wall Street forecasts. However, the underlying figures still point to a lot of the legacy operations. This is the problem that people like IBM are having, which is, talking to some people in the tech industry, they're actually getting a little bit excited about Microsoft again, because Microsoft is now starting to put some real money behind things like AI, things that are more R&D related in a Google-esque type fashion, starting to spread away from these more legacy type systems and operations which are now somewhat defunct, and IBM being certainly one of those. So a bit of a mixed bag with those earnings from last night. Other things and other headlines that I've seen of interest from really this morning. I saw an interesting note out of Barclays, because obviously we've, when you look at the S&P, if we flick back to the S&P chart and put it on a slightly longer dated, now we had this phenomenal rally post-Brexit on the back of this kind of renewed hope that central banks will continue to prop up the market. That very much being the case, certainly from Japan to the ECB all the way through to the Bank of England, and the delaying of rate hikes in the US certainly saw this S&P price up to those record levels just shy of that 2200 mark. We've then kind of consolidated since then. But what Barclays was saying, and they're more focused on European assets than they are in the US, but they're talking about investors should buy European equities, regardless of whether the Fed raises borrowing costs in the next 3 months. Now, obviously, when I read these types of headlines, I need to take, you've done your flow trader simulation, you know full well that these banks can often be pushing a view to support their inventory on their book and so on and so forth. But what they're suggesting is that the region stocks, which has suffered a 7.8% decline in 2016, have scope to rally through the end of the year if earnings remain stable. One of those metrics that we have seen is that although Alcoa was poor at the beginning of earnings season, the bank stocks certainly have been better than expected. What they're saying is then, at the moment, Europe is a buying opportunity, even if the Fed hikes. When you look at the amount of global support from the Bank of Japan, the ECB, the Bank of China, and even the Fed itself, where rates are quite low, the overall picture remains very supportive of stock markets. Because that's key. If you think about it, we're talking about a 25 basis point hike from the Fed. And then ultimately, what we're going to likely see when the Fed do hike rates is a new communication that actually the trajectory of rate increases thereafter is going to be extremely slow. So you're going to get what could be deemed then as a would be a dovish hike. So hike, which would be kind of hawkish in a sense, but the market's very much prepped for that. But then it's going to be supplemented by a very dovish and shallow rate of rate increases thereafter in the medium to long term. So that being said then, would that not be supportive of equities? And then certainly coming in an environment of QQE in Japan, the further tweaks and extension we're expecting from the ECB in December for their QE program, and the Bank of England and what they've been doing. So just quite interesting. And the other side of this as well, which you could suggest supports this view, is this table. We've been so consumed by the US elections, you've almost forgot about the political risk in Europe, which could still derail the recovery, especially Italy is the one that's in focus the most. That's because Italy's Senate referendum on the 4th of December is going to be a real key one, because PM Renzi has really pinned his flag to that in a Cameron style, that it either is successful or he steps down. And obviously political uncertainty is a net negative, which will likely be responded to with more accommodation from a central bank perspective. So here, rejection negative, but not necessarily means new election, but even tail risk would weigh on sentiment. Overall risk exacerbated by the fact that key challenges are low growth and bank concerns will remain. Let's not forget, this is politics. This is irrespective of the fact that the banking sector and the amount of bad debt on the Italian banks is still the same status quo. It's an absolute disaster when you talk about the size of the numbers. And so Italy's a real risk. You've got Spain, which ultimately has been under a tear-cake of government since December 2015. 2 elections they've had have not yielded yet a firm parliamentary majority. So the deadline is looming, and otherwise election triggered. So there's Spain. There's also, this is a real key date for the diary potentially, it's the 21st of October. You've got DBRS rating review of the country, which could put Portugal's investment grade, that's what IG stands for, so Portugal's investment grade rating, making it illegible for ECB QE purchases. Because don't forget, the ECB QE program is contingent that a country cannot be deemed as junk across all of the major rating agencies. Therefore, it does not qualify for the program. So this is really important actually for Portugal, because Portugal is already rated junk by S&P, Moody's and Fitch. If DBRS does the same and they become ineligible for ECB QE purchases, that's going to be terrible news for Portugal, but it's ultimately might force the ECB's hand that they'll have to do something in the interim period to step in and prop up the market. Moving on though, what I really want to focus on is the UK markets, because I've had a few questions already about this, and it's about CPI, and the reason why CPI in the UK today could be very interesting. So this is going to come out at 9:30, so any cable traders definitely do not be in a position going into this number, but certainly be ready for when this number does hit the tape, because it will have the propensity to move the market, the sterling market for sure. Now, there's a couple interesting things that have been going on with this inflation side of things for the UK economy. For one, you've probably read details about this article in the FT. UK gilts facing their biggest monthly loss since 1992. So any of the newer guys, gilts essentially is the benchmark 10-year bond in the UK. So you guys are trading the Bund, that'd be the German, the 10-year in the US, the gilt is the UK markets. So long maturity UK government debt has been hit particularly hard in recent weeks. This is factoring sterling's decline. Longer dated gilts in dollar terms have tumbled more than 10% since the beginning of the month. That's 10% in literally the last 18 days. This outpaces even the losses at the depths of the financial crisis, to put it in some perspective. Now, an interesting part of this is that Monday's sharp gilt sell-off. If you remember when we came in yesterday, bunds and T-notes were already under pressure. We were looking at those comments from Janet Yellen about her kind of comfortableness with the fact that inflation is going to be rising in the future, and this really echoed what Mark Carney said on Friday. Because what he said was that the central bank was prepared to see some overshoot in its inflation target. Now this is important because it's these fears of inflation which make a bond's fixed payments less appealing. Have been stoked by the 18% decline in the pound against the dollar since the EU vote in late June. So essentially speaking, if the reason why you would buy a bond and hold it for maturity is because you think that, let's say, you're going to hold it for the period of 10 years or longer, and that you want that stable percentage coupon paying out each year. If inflation, though, if what they're saying is going to rise, and it's going to rise even beyond target, so in the case of the UK up to potentially 3% is what seems to be suggested, then surely you're better off than taking money elsewhere, i.e. out of the bond market. So it makes buying bonds less attractive, so that then sees the yield start to spike, and then you start to get some momentum selling in the gilt market, which then falls through in sympathy into bunds and T-notes. So hopefully that makes a bit more sense. So essentially you're going to see higher inflation is going to mean higher interest rates, so you get a better return than rather than the holding of government bonds to duration. So that's the reason for those moves. So it's been pretty interesting developments there for the UK, and that's why inflation is going to be key to look at going forward. Now, a good question I had yesterday was about how to interpret the numbers that will come out at 9:30. So it's the year-on-year CPI that's really key to monitor when trading the CPI figures. And what I've got here is the year-on-year UK CPI. So you can see we've been steady in both the July and August reading at 0.6%. Now the median consensus today is for 0.9. 0.9, you can see this is a 12-month. That would put us certainly the highest this chart is showing. 0.9 would put us the highest since the end of 2014. Now, this puts the Bank of England in a slightly sticky spot, obviously, because this is what prompted Mark Carney to make those comments. Because if inflation keeps going higher, the theory would suggest you need to hike interest rates to counter increasing inflation. Granted, we're at 0.6, 0.9%. We're still well below target of 2%. So it might take some time to get there, but certainly it's going to pick up pace, as you've seen with the likes of the My Gate scandal and other prices of goods, which are jumping up in terms of white goods a good 10%. So if this happens, obviously Mark Carney is not going to be in a situation where he's going to be wanting to hike rates, because at the moment we're in a period of economic fragility in terms of the UK. But in the same token, he can't cut rates. The actual probability of the Bank of England cutting rates has decreased substantially over the last week or so because of this inflationary aspect. What he doesn't want to do, though, is make the market think that he's going to flip that and start to hike, because that's also unrealistic because of, as I said, they'll need a lower interest rate environment in order to stimulate the economy. So what does he do? He says, I'm happy with inflation being above target. So that's why those comments were probably made by him. So looking at this number, I would say, though, the key risk when this comes out from a trading point of view is that the market then is heavily positioned for a stronger than expected number, i.e. the consensus is 0.9, the market bias is certainly for increasing inflation. So when I already know that's how the market's looking at this data and the way it's positioned, I would say then the bigger market reaction potentially could come if the number is lower. So if we get a 0.6 reading, we maintain the trend that's been seen in the last 2 months, and this price shock has not yet started to materialize as some of the underlying economic data, I would say the market move to the downside, maybe there's more scope for an aggressive pop. If you look at the way that cables traded over the last day, really. So this is from really yesterday afternoon. We've risen from around 121.50 all the way up to close to the 123 handle. So what I'm saying then is that potentially there could be more scope for downside on a low inflation print with less to the upside if we get a forecast beating number, if that makes sense. So this is when I kind of look at how the market's been trading into a release to get a bit of an idea of how reactions might pan out. So that's the key number to look out for later on this morning, 9:30. So already got about 35 minutes until that comes out. A quick run through though of other things to look out for today. And on the calendar, really, you've just got the CPI numbers from the US. They're also going to be in focus. Probably lesser so slightly, just given the timings with the Fed in December. But nonetheless, inflation will be keenly watched by those Fed officials. And then just a few other points that I thought I would share with you for some research that have just been sent this morning. And this really goes to show the market psychology and the change that we've had since Brexit, where those who were caught so blindsided are very cautious about being caught again. And now you're starting to get research notes, and certainly this did not exist. I did not see any banknotes talking about what if we had a Brexit. That was really seldom talked about. But now it's starting to come through. What if Trump wins? How might the market react? And this is an 84-page document. These guys don't mess around at Natexis. But some of the key things here, just to quickly share you the headlines of their report. They're saying the polls largely favouring Hillary Clinton, but given Brexit, a surprise cannot be ruled out. And what would happen if a Republican candidate were elected with a favourable Congress? Likelihood there would be a stagflationary environment, i.e. a spike in prices, but employment would be in focus, a high level of uncertainty as the effect of tax reforms and trajectory of public finances come into question. They're looking at a negative impact on US GDP, and obviously the big one that would probably be the trade that you would look at is the Mexican peso. Those poor guys are going to get absolutely killed in the FX market if Trump wins. You know, you've already seen the movement in their currency of late. It's obviously staged a bit of a recovery as Clinton has pulled away in the polls, but the texts are suggesting the peso would fall by more than 15% against the dollar, would be that their forecast. Obviously, they're looking at asset allocation. There'd be overweight gold would be one. They're looking at the dollar would initially appreciate, actually, they're looking at, but then would depreciate thereafter in the medium term, which is quite interesting assessment of things. One of the key things, obviously, that we've been looking at, and this is a section that they go into in their report about the summary of the candidates' proposals, and obviously the big one from a market's point of view is monetary policy. And you can see here the replacement of Yellen as chair of the Fed is one of the proposals that's being put forward by Donald Trump, which would be something of key importance for markets. With Hillary Clinton, more a case of continuity and no change. So yeah, just quite interesting to see more people. I'll try and circulate some of this around to you guys so you can have a read. And then finally, this is just something I thought was quite funny. Again, from a psychology point of view, was this. Anyone heard of that creepy clown thing going around at the moment? The creepy clown craze sweeping the planet. HSBC are talking about it in their research note. They say it's just another example of irrational herding behavior of crowds. They're looking at, as McLean's Trian brain theory points out, with respect to the basal ganglia and limbic system, human beings are hardwired to produce the copycat behavior which produces trends and mania. That's actually quite interesting, because they say stock markets are driven by crowds of human beings, and that is why they are fundamentally irrational, and herding behavior directs market movements at every degree of trend, from the short term to the long term. So they're a tenuous link, but the creepy clown craze being maybe I should come in tomorrow and deliver the briefing. I know Andy would be very pleased if I did it in a creepy clown costume tomorrow. But yeah, the herd behavior is really interesting, and certainly something which you guys will certainly get more attuned in to once you get more experienced with watching financial markets on a day after day, month after month, year after year basis. But it does go to show the way that market moves, sometimes irrespective of some of the underlying fundamentals. Okay, guys, gonna wrap it up with that. Coming up to 9 o'clock, so you've got UK inflation numbers will be key. They're coming up in half an hour's time, so good luck and enjoy your trading day.